Philtown begins with a very simple but powerful promise. You can make money in the stock market no matter what the market is doing. Up or down. Bull or bear. Prosperity or recession. The key is not to gamble or take blind risks, but to follow a principle so simple that even beginners can understand it. This principle is called Rule Number 1. It comes from Warren Buffett, who famously said, Rule Number 1. Never lose money. Rule Number 2. Never forget Rule Number 1. Town builds his entire book around this idea. At first, it may sound impossible. After all, everyone has heard that the market is unpredictable. Stocks go up and down every day. How can anyone invest without losing money? Town answers this by reminding us that the stock market is not a casino. It is a marketplace for buying and selling real businesses. And if you learn how to identify strong businesses, buy them at the right price, and hold them with discipline, you can protect your wealth and grow it steadily. He shares his personal story to make this clear. Years ago, he was not a financial expert. He was a river guide earning a modest living. He had no background in economics or Wall Street. But after learning the principles of Rule Number 1 investing, he transformed his financial life. This message is meant to inspire every reader who feels that investing is too complicated or reserved only for professionals. Town also explains why this book matters now more than ever. Many people trust their future to mutual funds or so-called experts. They hand over control of their retirement accounts and hope for the best. But the truth is harsh. Most mutual funds fail to beat the market. Fees quietly eat away at returns. And financial advisors are often more focused on their own commissions than on your success. By following Rule Number 1, you take back control of your money. The introduction is not just motivational, it sets up the method. Town tells us that the book will teach step by step how to apply Rule Number 1. You will learn how to spot great businesses, how to measure their financial strength, how to calculate their true value, how to buy them at a discount, and when to sell them. He makes a promise. If you learn and practice the steps, you can grow your money at rates much higher than the average investor. And you can do this safely, with less stress, and with more confidence. But before he can explain the system, Town needs to clear the fog. Most of us carry wrong ideas about investing. We believe stories told by Wall Street, financial media, and so-called experts. These stories keep us fearful, confused, and dependent on others. That is why, before showing how to invest, Town takes us into the first chapter. It is about the myths of investing. The lies that stop ordinary people from becoming extraordinary investors. And so, with the foundation of Rule Number 1 firmly set, the journey begins. Chapter 1. The Myths of Investing. When people think about investing, most of them imagine a confusing world filled with charts, numbers, and financial experts in expensive suits. Many ordinary people feel that investing is something only Wall Street professionals can understand. They believe the stock market is a game for the rich and powerful, not for someone like them. Philtown begins by telling us that these beliefs are myths, and if we do not break them, we will remain trapped in financial dependence. The first myth is that investing is the same as gambling. We hear stories about people losing their life savings when the market crashes. We watch movies where traders shout and panic as numbers fall. All of this creates the idea that investing is just rolling dice at a casino. Town explains that this is false. Gambling is taking blind risks without control. But investing, when done correctly, is about certainty. It is about buying great businesses with predictable futures at safe prices. The difference is night and day. The second myth is that you need to be a financial genius or a math wizard to invest successfully. Many people think they are not smart enough to understand balance sheets, cash flows, or market analysis, so they avoid learning. Instead, they hand over their money to mutual funds or financial advisors. Town says this is another trap. You do not need a degree in finance. You only need a clear process. With simple tools, even someone with no background can analyze a business and make smart decisions. He reminds us that he himself was once a river guide, not a Wall Street banker. If he can do it, anyone can. The third myth is that mutual funds are the safest way to grow your wealth. Most people believe that professionals who run mutual funds know better. They believe that by giving their money to these funds, they will automatically get good returns. Town shows how this is not true. Studies prove that most mutual funds fail to beat the market average. Why? Because of hidden fees, commissions, and expenses. On top of that, mutual funds often own dozens or even hundreds of companies. This makes it impossible for the fund manager to focus on finding only the very best businesses. The result is mediocre performance. Another myth is that investing is only for people with a lot of money. Town breaks this belief by showing that even small amounts, when invested correctly, can grow into large fortunes over time. The key is compounding. When you reinvest your profits year after year, the money multiplies. What seems small in the beginning becomes massive in the long run. Waiting for a big paycheck to start investing is just an excuse. The best time to start is now, no matter how little you have. There is also the myth that the market is too unpredictable. Many people believe there is no way to know which company will succeed or fail, so they avoid investing altogether. Town says this fear comes from not knowing what to look for. The truth is that some companies have clear advantages that make them safer bets. These advantages are visible if you know how to measure them. Rule number 1. Investing is about focusing on such businesses. Town's message in this chapter is clear. The myths are designed to keep you dependent on others. Wall Street benefits when you feel too scared or too unqualified to invest on your own. Financial advisors benefit when you believe you cannot manage your own money. The media benefits by selling fear and excitement about the market. But the truth is simple. With the right knowledge and discipline, ordinary people can invest better than the so-called professionals. By breaking these myths, Town prepares the ground for the next step. If investing is not gambling, if you do not need to be a genius, if mutual funds are not the answer, then what is? How do we invest safely and profitably? That is where rule number 1 comes in. Chapter 2. Rule number 1 and the 4 M's Phil Town now lays out the foundation of his entire investing philosophy. He reminds us of Warren Buffett's words. Rule number 1. Never lose money. Rule number 2. Never forget rule number 1. At first, this sounds impossible. How can you never lose money in a market that rises and falls every day? Town explains that the secret is not in predicting the market, but in choosing the right businesses using a framework he calls the 4 M's. The 4 M's are meaning, moat, management, and margin of safety. These 4 ideas act like filters. If a company passes all 4 tests, it is worth investing in. If it fails even one, you should walk away. This way you avoid bad businesses and protect yourself from unnecessary risks. The first M is meaning. Town says that you should only invest in businesses that have meaning for you. Meaning is about personal connection and understanding. If you work in healthcare, you may understand a medical company better than a software company. If you are passionate about technology, you may naturally follow the growth of tech firms. By choosing businesses that fit your circle of competence, you avoid confusion and mistakes. Warren Buffett calls this staying within your circle. When you truly understand what a company does and how it makes money, you can judge whether it has a future. The second M is moat. Just like a castle with a moat is protected from enemies, a business with a moat is protected from competitors. Town explains that there are different types of moats. Some companies have strong brands that people trust. Others have patents or secrets that nobody can copy. Some control a toll system, like Microsoft charging fees for Windows. Others make it hard for customers to switch, like banks or subscription services. And some can always sell cheaper than competitors because of scale, like Walmart. A business with a wide moat can keep making profits for many years without losing customers to rivals. The third M is management. A great business with bad leadership will eventually fail. Town reminds us that we are not just buying numbers on a screen. We are trusting real people to make decisions. Good managers treat shareholders like partners. They reinvest profits wisely. They avoid too much debt. They act with integrity. On the other hand, greedy managers may pay themselves huge bonuses, issue too much stock, or make reckless acquisitions. By studying the history and behavior of leaders, you can judge if they deserve your trust. The fourth M is margin of safety. This is perhaps the most important. Even the best business can become a bad investment if you pay too high a price. Town says you must always buy at a discount. If a company is worth $100 per share, you should not pay $100. You should wait until it falls to around $50 or $60. This gap between the true value and the price you pay is your safety margin. It protects you if your calculations are slightly wrong or if the market has surprises. Benjamin Graham, the teacher of Warren Buffett, made this principle famous. Together, these four M's form a shield. They ensure that you only buy businesses you understand, that are protected by competitive advantages, run by honest managers, and available at bargain prices. When you follow this method, you avoid speculation. You stop guessing about the market. You focus only on businesses that can grow your money safely. Town emphasizes that this system is not theory. It is how the best investors in the world operate. Buffett, Munger, and others follow these exact principles. The difference is that now you too can use them. Rule number 1: investing is not about luck. It is about discipline and patience. With the 4 M's explained, Town prepares us for the next step. If we are to buy businesses instead of stocks, we must learn to think like business owners. Chapter 3. Buy a business, not a stock. Phil Town now shifts our perspective. He says the biggest mistake most investors make is treating stocks like lottery tickets. They watch the price jump up and down every day and hope to guess the right moment to buy or sell. This mindset is dangerous. It makes people emotional, impatient, and easily manipulated by Wall Street noise. Town tells us that the true secret is to stop thinking of stocks as little pieces of paper. Instead, we must think of them as ownership in real businesses. When you buy a share, you are becoming a part owner of the company. That means you are buying into its products, its employees, its customers, and its future. If you only focus on the stock price, you miss the bigger picture. But if you focus on the business itself, you begin to see investing differently. You are not just trading symbols on a screen. You are building a collection of great companies that you would proudly own for life. Town explains that this is exactly how Warren Buffett invests. Buffett does not care if the market opens tomorrow or closes for 10 years. He only cares about owning businesses that will keep making money for decades. This mindset is what separates investors from speculators. Investors ask, would I be happy to own the entire business if I could? If the answer is no, then it is not worth buying even one share. To make this practical, Town suggests a test. Imagine you had enough money to buy the entire company, not just a single stock. Would you still be interested? Would you feel proud to own it and pass it on to your children? If the answer is yes, then it might be a worthy investment. If the answer is no, then walk away. This way, you avoid buying into businesses you do not believe in. He also warns against getting caught up in market chatter. The media often hypes up companies because of trends, short-term news, or emotional excitement. But most of those businesses will not survive long-term. A real investor ignores the noise and focuses on fundamentals. The question is never, will the stock go up next week? The question is, will this business still be strong and profitable 10 years from now? Town also reminds us that buying businesses requires patience. Great opportunities do not come every day. Sometimes you may study dozens of companies before finding one worth buying. But when you do, the rewards are powerful. Because once you own a truly great business, you can hold it with confidence and let compounding do its magic. Another key lesson in this chapter is that owning a business means accepting responsibility. You cannot just blindly buy and hope. You must understand how the company makes money, who its competitors are, and what risks it faces. This level of awareness protects you from panic when the stock price moves. If you know the company is solid, you will not be shaken by temporary market swings. By thinking like an owner, you also align your mindset with the leaders of the company. You want them to act like owners too, making smart, long-term decisions instead of chasing quick profits. This owner-to-owner perspective keeps your focus on the real drivers of wealth, not the daily drama of Wall Street. Town concludes the chapter by saying this: buying a stock without understanding the business is like buying a car without opening the hood. You may get lucky, but most likely you will regret it later. But if you study the engine, test the performance, and know exactly how it runs, then your purchase is safe. The same is true for investing. Look at the business first, not the stock price. This prepares us for the next step in the rule number 1 journey. If we are to buy businesses, then we must learn how to judge their strength. What makes one company better than another? How do we know if a business can defend its profits against competitors? The answer lies in the idea of a moat. Chapter 4. Identify a moat. Philtown now introduces one of the most important concepts in rule number 1 investing, the moat. A moat is what protects a business from its competitors, just like a castle moat protects a fortress from invaders. Without a moat, even a strong company can be easily attacked, lose customers, and fail. Town emphasizes that identifying a moat is essential because it separates the businesses that can survive and thrive for decades from those that may struggle or disappear. He explains that not all businesses have moats. Some succeed for a short time because of trends or luck, but without protection, they are vulnerable. The goal of an investor is to find companies with wide and durable moats. A wide moat allows a business to maintain high profits over time, even when competitors try to copy its products or take its customers. Town identifies 5 main types of moats. The first is the brand moat. This is when people trust and prefer a company's product over others. Examples include Coca-Cola or Apple. People are willing to pay more for these brands because they know and love them. A strong brand moat means the company can charge premium prices and maintain loyalty even when competitors appear. The second type is the secret moat. This is when a company has patents, special technology, or unique processes that others cannot copy. Secrets create a barrier to entry for competitors, allowing the company to dominate its market without worry of imitation. The third type is the toll moat. This happens when a company controls access to something essential. For example, Microsoft charges license fees for Windows software. Competitors cannot replace it easily because businesses rely on it. The toll moat ensures a steady and reliable stream of revenue. The fourth type is the switching moat. This occurs when customers find it difficult or costly to switch to a competitor. Banks, insurance companies, and subscription-based services often have this type of moat. Once a customer is on board, leaving is inconvenient, time-consuming, or expensive, which keeps the company safe from competitors. The fifth type is the cost or price moat. Some companies can produce goods or services cheaper than anyone else due to scale, efficiency, or control over resources. Walmart is a classic example. Its low-cost advantage keeps competitors from easily taking market share. Town stresses that a great business may have more than one type of moat. The wider and more durable the moat, the safer the investment. When you combine a strong moat with competent management, high growth, and a margin of safety, you create a business that can protect your wealth for decades. He also explains how to spot a moat in practice. Look at a company's history. Has it maintained profits even when competitors entered the market? Does it have pricing power? Do customers remain loyal? These are signs of a strong moat. Conversely, if profits fluctuate wildly, the business struggles against competition, or customers frequently leave, the moat may be weak or non-existent. Town warns that many investors ignore moats. They see a stock with a low price or recent hype and buy it without understanding its business advantages. This is dangerous. A business without a moat is like a castle without walls. It may survive for a while, but eventually, competition will erode its profits and the stock will fall. By identifying moats, you are learning to separate short-term fads from long-term winners. This skill helps you focus your money on businesses that will continue to grow, protect your wealth, and allow compounding to work its magic. The chapter concludes by linking to the next step. Once you know how to find a moat, you need a way to measure the company's financial strength. The next chapter introduces the big 5 numbers, which tell you whether a company is truly as strong as it seems. Chapter 5. The Big 5 Numbers. Philtown now shifts the focus from qualitative factors like meaning, moat, and management to quantitative measures that reveal a company's financial strength. He calls these measures the Big 5 Numbers. These are the key figures every Rule Number 1 investor must understand before buying a business. By analyzing these numbers, you can see whether a company is growing consistently and whether it will continue to thrive in the long term. The first number is Return on Invested Capital, or ROIC. This tells you how efficiently a company uses the money it has to generate profits. A high ROIC means the business can turn investments into earnings better than most competitors. Town emphasizes that a consistently high ROIC over many years indicates a strong and well-managed company. If the ROIC fluctuates wildly or declines, it could be a warning sign that the business is losing its competitive advantage. The second number is earnings growth. Earnings are the company's profits, and growth shows whether the business is expanding its ability to make money. Town recommends looking at long-term earnings growth, ideally over 10 years. Consistent growth demonstrates that the company's products or services remain in demand, and the business model works even through economic cycles. The third number is equity growth. This shows how the company increases its net assets over time. Equity grows when profits are reinvested wisely, and the company avoids unnecessary debt. A growing equity indicates a solid financial foundation, meaning the company can fund future expansion, pay dividends, or weather downturns without risking bankruptcy. The fourth number is sales growth. While earnings are important, sales growth shows the top line, the total revenue coming into the company. Steady sales growth signals that customers continue to buy the product and that the company's market share is stable or increasing. Declining sales, even with high earnings, can signal problems ahead. Town explains that true long-term investors must look at both earnings and sales to get the full picture. The fifth and final number is cash flow growth. Cash is the lifeblood of a business. Profits on paper mean little if a company does not generate actual cash to pay bills, reinvest, or reward shareholders. Cash flow growth ensures that the company can sustain operations, fund growth, and provide stability. Town stresses that businesses with strong cash flow are much safer investments than those that rely heavily on borrowing or accounting tricks. Together, these 5 numbers provide a complete snapshot of a company's health. A business with consistent ROIC, earnings, equity, sales, and cash flow growth is likely to be strong, well-managed, and capable of surviving economic challenges. Conversely, a company that fails in one or more areas may be risky, even if it seems attractive on the surface. Town also emphasizes simplicity. You do not need complex spreadsheets or expensive software. Publicly available financial statements and simple calculations can reveal all 5 numbers. What matters is consistency and discipline. Investors who ignore these numbers are essentially guessing, while those who follow them are investing with knowledge and confidence. By mastering the big 5 numbers, you gain the ability to distinguish between a mediocre business and a great one. You can separate hype from reality and make decisions based on facts, not emotions. These numbers are the backbone of Rule Number 1 investing because they give you a clear, measurable way to identify long-term winners. Chapter 6. Calculate the Big 5. Philtown now takes us from theory to action. Knowing the Big 5 numbers is important, but to make Rule Number 1 investing work, you must learn how to calculate them accurately. This chapter shows step by step how to take public financial information and turn it into meaningful insights about a company. Town emphasizes that this process is simple, even for beginners, if approached methodically. The first number, Return on Invested Capital, ROIC, shows how efficiently a company uses its money to generate profits. Town explains that you can calculate ROIC by dividing the company's net profit by the total capital invested in the business. You can find these numbers in public financial statements. A high and consistent ROIC over time indicates a company that knows how to use its resources wisely. Town warns that fluctuating ROIC is a sign of inconsistent management or market instability. Next is earnings growth. This measures how much the company's profits have grown over a period of years. Town recommends looking at long-term growth, ideally 10 years, to see the real trend beyond short-term ups and downs. You calculate it by comparing net profits from year to year and averaging the growth. Consistent growth shows that the company's products or services are in demand and that management is effective. The third number, equity growth, measures the increase in shareholders' value. Town shows that you can calculate this by subtracting liabilities from assets to find equity each year, and then observing how it changes over time. A company that steadily grows equity demonstrates financial stability and the ability to reinvest profits wisely, which is essential for long-term success. Sales growth is the fourth number, and it measures the increase in revenue over time. Town emphasizes that revenue growth tells you if the company is attracting more customers or selling more products. Calculating it involves comparing yearly sales figures and finding the average growth. A business with rising sales is generally healthier than one with stagnant or declining sales, even if profits temporarily appear high. Finally, cash flow growth reveals the real money a company generates. Earnings on paper are not enough. A company must produce cash to survive and grow. To calculate cash flow growth, you examine the cash flow statements and annual reports, looking at the increase in cash from operations year after year. Consistent cash flow growth ensures the company can pay dividends, reinvest, and withstand economic challenges. Town stresses that all 5 numbers should be looked at together. A company with strong earnings but weak cash flow, for example, may be using aggressive accounting or taking on too much debt. Likewise, strong ROIC with declining sales may indicate a short-term advantage that cannot last. By calculating all 5 numbers, you get a complete picture of the company's financial health. He also reassures beginners that they do not need to memorize complicated formulas. Online tools, company reports, and spreadsheets can help simplify the process. The key is consistency and understanding the story behind the numbers. By the end of this chapter, you should feel confident in assessing whether a company is strong enough to invest in. Once you can calculate the big 5 numbers, the next step is to evaluate the leadership behind the business. After all, even a strong company can fail if the people running it make poor decisions. In the next chapter, Town teaches us how to bet on the jockey, focusing on the management team and their ability to steer the company to long-term success. Chapter 7. Bet on the jockey. Town now shifts focus from numbers to people. He reminds us that investing is not just about financial statements or stock prices. Even a company with strong earnings, growing sales, and a wide moat can fail if the management team is weak or dishonest. Town calls this principle, bet on the jockey. Just like a great horse needs a skilled rider, a great business needs strong leaders to guide it. Town explains that the jockey is the company's management team. These are the people making decisions about products, growth, investments, debt, and strategy. Investors must study these leaders carefully because their decisions directly impact the company's long-term success. A brilliant business with poor leadership can lose value quickly. Conversely, average companies with exceptional leaders can turn into extraordinary successes. There are 3 key qualities Town looks for in a jockey. The first is integrity. You want leaders who act honestly and put shareholders first. Have they been truthful in reports and communications? Do they avoid self-serving practices or risky shortcuts? Trust is critical because, as an investor, you cannot watch over every decision. If the jockey is dishonest, your money is at risk no matter how strong the numbers look. The second quality is competence. A leader must be capable of making smart, informed decisions. Town suggests examining their track record. Have they successfully led previous companies? Do they understand the business and industry deeply? Competence also includes the ability to adapt to change, innovate, and manage growth responsibly. A competent jockey ensures that the company can maintain its moat and continue growing. The third quality is alignment with owners. Great managers think like owners, not just employees. They reinvest profits wisely, avoid unnecessary debt, and focus on long-term value creation. Town emphasizes that you should feel confident that the management team has the same goal as you, to grow and protect shareholder wealth. Leaders who act like owners are much more likely to make disciplined, thoughtful decisions rather than chasing short-term profits or personal gain. Town also explains practical ways to evaluate the jockey. Look at the annual reports, listen to interviews, read shareholder letters, and study past decisions. How did they handle crises? How have they invested profits? Are they transparent and accountable? Even small details, like compensation structure, can reveal whether leaders are motivated by personal gain or long-term success. He warns against being swayed by charisma alone. A CEO may be charming, persuasive, or famous, but that does not guarantee good decisions. Investors must look at evidence of integrity, competence, and alignment over time. Past performance and consistent behavior are stronger indicators than personality or media hype. Betting on the jockey also connects directly to the 4 M's from Chapter 2. Even a company with a wide moat or meaningful business can fail if leadership is weak. By combining a strong moat with skilled and honest management, you greatly increase the likelihood of safe and profitable investing. By the end of this chapter, you understand that numbers alone are not enough. A great business requires a great jockey to steer it. With strong leadership in place, the next step is to ensure your investment is protected. That is where the principle of margin of safety comes in. In the next chapter, Town shows how to demand a margin of safety, buying only when the stock price allows room for error, and protecting your investment from potential mistakes or market volatility. Chapter 8. Demand a margin of safety. Phil Town now introduces one of the most important rules in rule number 1 investing, the margin of safety. He explains that even the best businesses, with strong moats and excellent management, are not immune to mistakes or unexpected events. The stock market can be unpredictable, and prices often swing wildly. To protect yourself and your money, you must always buy with a margin of safety. The margin of safety is the difference between the company's intrinsic value, what it is truly worth, and the price you pay for it. If a business is worth $100 per share, you should aim to buy it at a significant discount, perhaps $50 or $60. This gap provides a cushion in case your calculations are slightly off or unforeseen events affect the company or the market. Town emphasizes that this principle is the cornerstone of safe investing. Town explains why the margin of safety works. Investing without it is like walking on a tightrope without a safety net. One small mistake, or one unexpected market drop, and you could lose a large portion of your investment. But when you buy at a discount to intrinsic value, even if things go wrong, your losses are limited. This allows you to sleep at night and avoid panic selling. He also links the margin of safety to human psychology. Investors are naturally emotional. They fear losing money and greedily chase rising stocks. The margin of safety removes emotion from the equation. By focusing on price relative to value, you make rational, disciplined decisions instead of following the crowd or reacting to headlines. Town introduces a practical way to find the margin of safety. First, you must estimate the intrinsic value of a company using the big 5 numbers, financial statements, and growth projections. Next, determine the discount at which you are comfortable buying. This discount depends on your confidence level and your tolerance for risk. A larger discount offers more protection, but may require patience to find opportunities. He also warns against common mistakes. Many investors ignore the price and assume that a great company is always worth buying. This is dangerous. Even the best businesses can be overvalued, and buying at too high a price increases risk. Others wait too long for a perfect price and miss opportunities. Town stresses that the margin of safety is about balance. Enough discount to protect yourself, but not so extreme that you never invest. Town connects this principle to the earlier chapters. A company with a strong moat and skilled management is still vulnerable if you pay too much for it. The margin of safety ensures that your judgment and calculations create a real protective barrier. It is a discipline that separates smart investors from speculators. By the end of the chapter, you understand that investing is not about chasing the hottest stock or predicting short-term market moves. It is about buying strong businesses at prices that allow room for error. This principle, combined with the big 5 numbers, the Moat, and the Jockey, forms the backbone of rule number 1 investing. The next step is practical. Once you know the intrinsic value and the margin of safety, you must calculate the sticker price, the actual price at which you should buy the stock. In the next chapter, Philtown shows how to determine this number and take action with confidence. Chapter 9. Calculate the sticker price. Philtown now teaches one of the most practical steps in rule number 1 investing, calculating the sticker price. The sticker price is the maximum price you should pay for a stock to ensure a safe and profitable investment. It combines the concept of intrinsic value with the margin of safety, giving you a clear number to guide your buying decisions. Town explains that many investors fail because they do not know the sticker price. They see a great company and want to buy it at any price. Others rely on guesswork, hoping the market will rise. Both approaches are dangerous. The sticker price removes guesswork and emotion. It is a disciplined way to decide when a stock is truly a bargain. To calculate the sticker price, you first need the company's intrinsic value. This comes from analyzing the big 5 numbers, understanding the business's moat, and projecting future growth. Once you have the intrinsic value, you apply your margin of safety. For example, if a company is worth $100 per share and you want a 50% margin of safety, your sticker price would be $50. This is the highest price you should pay. Town emphasizes that the sticker price is not a magic number. It is an estimate based on careful analysis. Different investors may calculate it slightly differently depending on their assumptions about growth, risk, and confidence. The key is to be conservative, realistic, and disciplined. Overestimating the sticker price is a common mistake that leads to paying too much for a stock. He also explains that the sticker price is dynamic. As market conditions, business performance, or company fundamentals change, the intrinsic value and margin of safety may change too. Smart investors continually review their calculations to ensure that they are buying at a safe price. This ongoing evaluation is part of the rule number 1 approach. Town illustrates this concept with examples. Suppose a company is growing steadily, has a strong moat, and excellent management. Its intrinsic value is calculated at $100 per share. By applying a 50% margin of safety, you set the sticker price at $50. If the stock is currently $60, you wait. If it falls to $45, you buy. This process removes emotion and speculation from investing. He also points out that calculating the sticker price protects against mistakes in judgment. Even if your growth projections are slightly too optimistic or unexpected market events occur, the margin of safety ensures that your downside risk is limited. Over time, consistently buying below the sticker price allows compounding to work in your favor, growing wealth safely. By the end of this chapter, you understand that the sticker price is your practical tool for disciplined investing. It tells you when to act and when to wait. It transforms vague ideas about good deals into concrete, measurable actions. The next step is about timing. Knowing the sticker price is essential, but you must also understand when to sell. Buying is only half the battle. In the next chapter, Philtown shows how to recognize the right moment to exit a stock and protect your gains. Chapter 10. Know the right time to sell. Philtown now turns to a question every investor must face. When should you sell a stock? Many people focus only on buying at the right price, but knowing when to exit is just as important. Selling at the wrong time can destroy gains, while selling too late can lead to losses. Rule number 1. Investing is not just about buying wisely, it is also about selling wisely. Town explains that there are 3 main reasons to sell a stock. The first is when the business fundamentals change. Even a company you love can become a bad investment if its moat weakens, management makes poor decisions, or growth slows unexpectedly. For example, a strong brand may lose customer trust, or a secret technology may become obsolete. If the core advantages that made the company a great investment disappear, it is time to sell. The second reason is overvaluation. Town reminds us that a stock price can rise far above its intrinsic value. If the stock trades well above the sticker price and the margin of safety disappears, you are no longer protected. Selling at this point locks in profits and prevents losses if the market corrects. Patience in waiting for the right price is as important as the discipline to sell when it is reached. The third reason is personal financial needs. Sometimes life circumstances change, and you may need cash for emergencies, education, or other goals. While rule number 1 encourages long-term investing, practical realities cannot be ignored. Town emphasizes planning for such situations in advance so that selling decisions are deliberate rather than emotional. Town also addresses common mistakes investors make when selling. Many sell too early because they panic at short-term price drops. Others hold too long, driven by greed, hoping the stock will continue rising forever. Both behaviors reduce overall returns. Rule number 1. Investors sell based on logic, not emotions. They focus on changes in the business or valuation rather than market noise. He offers a practical approach. Continually monitor the big 5 numbers, management quality, and the moat. Watch for changes that indicate the business is no longer as strong as when you bought it. If any of these pillars weaken significantly, it signals the right time to sell. Similarly, track the stock price relative to your calculated sticker price. When the stock is far above the intrinsic value, consider taking profits. Town emphasizes that selling is not about timing the market. You do not need to predict short-term movements. Instead, selling is about responding to changes in the business and valuation. By following these principles, you protect your wealth and avoid emotional decisions that often lead to mistakes. By the end of this chapter, you understand that successful investing involves both buying wisely and selling wisely. Knowing when to sell ensures that your gains are preserved and that you continue to make smart investments over time. The next step is action. Once you know when to buy and sell, you need the courage and discipline to act. In the next chapter, Phil Town teaches us how to grab the stick, how to take confident action, and start investing using rule number 1 principles. Chapter 11. Grab the stick. Phil Town now addresses one of the most important steps in rule number 1 investing, taking action. He calls it grab the stick. After learning all the principles, analyzing businesses, calculating sticker prices, and understanding when to sell, the final step is to act decisively. Many investors fail not because they lack knowledge, but because they hesitate. The key to success is combining knowledge with courage. Town explains that grabbing the stick means committing to the investment once all the criteria are met. You have calculated the big 5 numbers, confirmed a strong moat, assessed competent management, ensured a margin of safety, and identified the sticker price. Now it is time to make your move. Hesitation or overthinking can cause missed opportunities. Successful investors act when the odds are in their favor. He emphasizes that action must be disciplined, not impulsive. You are not gambling or chasing trends. You are making a calculated investment based on careful analysis. Rule number 1. Investing removes emotion from the decision. By acting only when all the conditions are met, you increase the likelihood of success and reduce the risk of mistakes. Town also warns against fear and procrastination. Many people know what they should do, but wait for the perfect moment, which never comes. Markets will not wait for you. Companies with strong fundamentals and wide moats continue to grow. By waiting too long, you may miss a chance to buy at the sticker price or take advantage of favorable market conditions. He encourages small, consistent steps. If you are new to investing, start with 1 or 2 companies you fully understand and meet all rule number 1 criteria. This allows you to gain confidence, experience, and discipline without taking unnecessary risks. As your knowledge and comfort grow, you can expand your portfolio. Town also stresses patience. Grabbing the stick does not mean buying the first stock that meets your criteria. Sometimes you must wait for the price to reach your sticker price. The combination of patience and action ensures that you buy at a safe price and maximize long-term gains. Another important aspect is responsibility. When you act, you are taking ownership of your financial future. Town reminds readers that investing is a personal journey. You must take control and make decisions based on your analysis, not hearsay, media hype, or others' advice. Grabbing the stick is about empowerment and discipline. By the end of this chapter, you understand that knowledge alone does not create wealth. Action, taken with discipline, courage, and preparation, is what turns understanding into results. Once you grab the stick, the next step is to equip yourself with the right tools to make investing easier and more effective. In the next chapter, Philtown introduces the 3 tools that every Rule Number 1 investor should use to simplify analysis and decision-making. Chapter 12. The 3 Tools. Philtown now introduces 3 essential tools that simplify Rule Number 1 investing. These tools are not about shortcuts or guessing. Instead, they help investors analyze businesses, calculate intrinsic value, and make confident decisions faster. Town emphasizes that even beginners can use these tools to invest like professionals. The first tool is the ROIC tool. ROIC stands for Return on Invested Capital. This tool helps you calculate how efficiently a company uses its money to generate profits. By inputting data from financial statements, you can quickly see whether a business earns more than it costs to operate. A high ROIC over many years signals a strong and well-managed company, while a low or declining ROIC is a warning sign. Town stresses that the ROIC tool is vital for evaluating whether the company can sustain growth and maintain its competitive edge. The second tool is the EPS and Sales Growth tool. EPS stands for Earnings Per Share. This tool allows you to track the growth of both profits and sales over time. By comparing year-to-year data, you can see trends, spot consistency, and identify potential red flags. Growth is one of the most important factors in long-term investing, and this tool makes it easier to quantify. It also helps you determine the intrinsic value of the company by projecting future growth, which is essential for calculating the sticker price. The third tool is the valuation tool. This combines all the previous calculations and applies the margin of safety to determine the sticker price. By using this tool, you can see the maximum price you should pay for a stock, ensuring that you invest safely and wisely. Town explains that this tool removes guesswork and emotion from buying decisions. Instead of reacting to market hype or fear, you base your choices on facts, numbers, and a disciplined process. Town emphasizes that these tools work together. The ROIC tool shows how efficiently the business uses capital. The EPS and Sales Growth tool measures its growth trajectory. The valuation tool combines both with the margin of safety to provide a concrete sticker price. Using all 3, investors can quickly and confidently identify the best opportunities while avoiding mistakes. He also reassures beginners that using these tools does not require advanced math or expensive software. Financial statements, spreadsheets, and online calculators are enough. The key is consistency and understanding what each tool measures. Over time, these tools become second nature, allowing you to analyze businesses quickly and accurately. Town concludes the chapter by linking the tools to action. Once you understand the 4 M's, the big 5 numbers, the margin of safety, and how to calculate the sticker price, the tools allow you to put everything into practice efficiently. You are no longer guessing or following the crowd. You are investing with clarity and discipline. The next step is small, practical action. Once you have the knowledge and tools, you must start investing gradually. In the next chapter, Philtown explains how to take baby steps, building confidence and experience before making larger investments. Chapter 13. Take baby steps. Philtown now focuses on the practical side of investing, getting started without feeling overwhelmed. He emphasizes that knowledge alone is not enough. Many beginners get excited about Rule Number 1 investing, but hesitate because they fear making mistakes. Town encourages readers to take baby steps, starting small and gradually building confidence. The idea of baby steps is simple. You do not need to invest large sums of money on your first try. Instead, pick one company that meets all Rule Number 1 criteria and make a small investment. This allows you to practice analyzing businesses, calculating sticker prices, and applying the margin of safety in a real-world setting without risking too much capital. The goal is learning, experience, and discipline, not immediate wealth. Town also stresses the importance of building a routine. Start by setting aside time each week to research companies, review financial statements, and use the 3 tools. By creating a consistent habit, you gradually become familiar with the process. Small, regular efforts compound over time, just like money in a strong business. Patience and repetition are key. He reminds readers that mistakes are part of learning. Even experienced investors make errors. The difference is that they start small, learn from their mistakes, and adjust their approach. Baby steps allow you to gain confidence and understand your own decision-making process without taking unnecessary risks. Town encourages journaling your investment decisions, noting why you bought or passed on a stock. Reviewing these notes helps refine your judgment over time. Another important point is managing emotions. New investors often feel fear, greed, or impatience. By starting small, you reduce the emotional impact of market fluctuations. You can observe how you react to gains and losses in a controlled way. This practice builds the emotional discipline needed for long-term investing success. Town also explains that baby steps create momentum. As you gain experience and see positive results, your confidence grows. You become more comfortable evaluating businesses, understanding moats, and calculating sticker prices. Over time, you can increase your investment amounts while maintaining discipline and caution. By the end of this chapter, you understand that starting small is not a sign of weakness, but a smart strategy. Investing is a lifelong journey, and the best investors grow gradually, combining knowledge, tools, and practical experience. Baby steps bridge the gap between theory and action, preparing you for larger investments in the future. The next chapter addresses obstacles. Even with knowledge, tools, and discipline, many people face barriers to investing. In the next chapter, Town teaches how to eliminate the barriers, removing excuses and challenges that prevent you from taking consistent action. Chapter 14. Eliminate the barriers. Town now addresses one of the most common reasons people fail to invest: barriers. These are obstacles, both real and imagined, that prevent you from taking consistent action. He emphasizes that knowledge, tools, and discipline are useless if you allow barriers to stop you. Rule number 1. Investing is as much about mindset as it is about strategy. Town identifies several common barriers. The first is fear. Many people are afraid of losing money or making mistakes. Fear can freeze decision-making, causing missed opportunities. Town reminds readers that investing is a calculated risk, not gambling. By using the big 5 numbers, the Moat, the Jockey, and the margin of safety, you minimize risk and make informed choices. Facing fear with preparation transforms it into confidence. The second barrier is lack of time. People often think they are too busy to research stocks or track investments. Town suggests using the 3 tools to simplify analysis and create a routine. Even dedicating a small, consistent amount of time each week allows you to research companies, calculate sticker prices, and monitor your portfolio without feeling overwhelmed. The third barrier is information overload. In today's world, investors are bombarded with financial news, stock tips, and opinions. Town advises filtering out noise and focusing on fundamentals. Stick to the rule number 1 principles: big 5 numbers, Moat, Jockey, and margin of safety. Ignore hype, rumors, and market panic. Discipline in information selection is crucial for success. Another barrier is self-doubt. Many people question their ability to understand investing. Town reassures readers that anyone can learn rule number 1 investing with patience, practice, and the right tools. Start with small investments, take baby steps, and review your decisions. Over time, experience builds confidence and competence. Town also discusses financial constraints. Some think they need large amounts of money to start investing. He emphasizes that even small amounts matter if invested wisely. Using sticker prices and margins of safety, you can invest in strong businesses without risking more than you can afford. Starting small allows you to learn while protecting your capital. Finally, Town stresses the importance of removing excuses. Common excuses include waiting for perfect timing, lack of knowledge, or fear of market fluctuations. The rule number 1 approach addresses each of these concerns. By following the steps, finding meaningful businesses, analyzing moats, calculating big 5 numbers, and using the margin of safety, you remove uncertainty and take confident action. By the end of this chapter, you understand that eliminating barriers is about mindset, preparation, and consistent action. Knowledge, tools, and discipline matter only if you remove the obstacles preventing you from applying them. The next chapter prepares you for your first real investment. After learning, analyzing, and removing barriers, you are ready to prepare for your first rule number 1 purchase, understanding exactly what steps to take before putting money into a stock. Chapter 15. Prepare for your first rule. 1 purchase. Philtown now brings everything together and prepares you for your first real investment. After learning the rule number 1 principles, analyzing businesses, calculating sticker prices, and eliminating barriers, it is time to move from theory to action. Preparation is key because the first purchase sets the foundation for your investing journey. Town emphasizes research and due diligence. Before buying, review the company's Big 5 numbers, ensure the business has a strong moat, and confirm that the management team is competent and aligned with shareholders. Check the intrinsic value and apply the margin of safety to determine the sticker price. This disciplined process ensures that your first investment is calculated, informed, and safe. He also stresses emotional readiness. Investing is not only about numbers. The market will fluctuate, and even strong businesses may experience temporary setbacks. You must be prepared to hold through these periods without panic selling. By understanding why you are investing and having confidence in your analysis, you reduce the risk of making emotional decisions that can harm long-term results. Town advises starting with a small, manageable investment. Even if you have a larger sum available, your first purchase should be modest. This allows you to gain practical experience, observe the company's performance, and test your decision-making process without risking too much capital. Small investments also reduce fear and build confidence as you see your rules applied successfully. He outlines a practical checklist for the first purchase. Verify the company's moat and its durability. Confirm the Big 5 numbers show consistent growth and strength. Ensure the management team has integrity, competence, and alignment. Calculate the intrinsic value and apply a sufficient margin of safety. Set your sticker price and only buy if the stock trades below it. Review your own emotional readiness to commit and hold the investment. Town also highlights the importance of record keeping. Maintain a journal of your investment decisions, the reasoning behind them, and the results. Documenting your first purchase creates a reference for future investments and helps refine your skills over time. Reviewing successes and mistakes accelerates learning and builds long-term discipline. Finally, Town reminds readers that investing is a journey, not a race. Your first purchase does not need to be perfect, but it must follow the rule number 1 principles. By preparing thoroughly, you maximize the probability of success while minimizing risk. Confidence, discipline, and patience are the pillars of long-term wealth creation. By the end of this chapter, you are ready to act. The final chapter ties everything together with questions and answers, addressing common doubts and clarifying key points. It ensures you are fully prepared to apply rule number 1 principles consistently and confidently. Chapter 16. QA. Philtown concludes rule number 1 with a practical question and answer section, addressing common doubts, challenges, and scenarios that investors face. This chapter ensures that readers are not just familiar with the rules, but are confident in applying them in real life. Town anticipates questions beginners, and even experienced investors often have, and provides clear, actionable answers. One common question is about risk. Many people ask, "What if I lose money?" Town explains that risk is part of investing, but rule number 1 minimizes it. By buying strong businesses with wide moats, competent management, and a sufficient margin of safety, you protect yourself from major losses. He reminds readers that calculated investing is very different from gambling. The margin of safety is your shield against mistakes, miscalculations, and market volatility. Another frequent question concerns timing. Investors wonder if they have to predict market highs and lows. Town stresses that timing the market is impossible and unnecessary. Instead, you focus on buying strong businesses below their sticker price. Waiting patiently for opportunities that meet all rule number 1 criteria is more effective than chasing trends or trying to time short-term movements. Discipline, not luck, is the key. Questions about how much money to invest are also common. Town advises starting small, especially for beginners. Baby steps allow you to gain experience, test your analysis, and build confidence. Over time, as your knowledge and comfort grow, you can increase your investment amounts. The focus is on consistent, disciplined application rather than the size of the initial investment. Many investors ask about emotions. Fear and greed often drive bad decisions. Town reminds readers that rule number 1 investing removes emotion from the process. By relying on clear analysis, sticker prices, and margins of safety, decisions are logical and systematic. Emotional swings are natural, but preparation and discipline allow you to stay focused on long-term goals rather than short-term market noise. There are also questions about what to do when a company changes. Town emphasizes vigilance. Continually monitor the big 5 numbers, management actions, and the moat. If fundamentals weaken or the stock price exceeds your sticker price, it may be time to sell. The rule number 1 principles are dynamic, not static. They require ongoing attention, even for strong companies. Finally, Town addresses common excuses. Some readers worry they are too busy, inexperienced, or lack capital. Town reassures them that rule number 1 is designed to be practical. The tools, principles, and step-by-step approach make it accessible to anyone willing to learn, take baby steps, and eliminate barriers. Consistent action, even small, compounds over time into significant wealth. By the end of this chapter, readers have a complete framework. They understand not only how to identify, analyze, and buy great businesses, but also how to manage investments, handle emotions, and navigate challenges. Rule number 1. Investing combines knowledge, tools, discipline, and courage, creating a systematic approach that anyone can follow to make money safely and consistently. Philtown closes with a reminder: investing is a journey. Success comes from preparation, patience, and repeated application of these principles. By following rule number 1, you are not just buying stocks. You are building a long-term, safe, and profitable investment strategy that grows wealth and reduces risk. If you found this summary of rule number 1 helpful and want more practical investing insights, tips, and book summaries delivered in a simple and engaging way, make sure to subscribe now. Stay updated, learn smarter, and start building your financial future with confidence. Don't miss out. Hit that subscribe button today.